Coming up on Market to Market, the global economic outlook improves while domestic trade skirmishes simmer, and exploring a sour note in a sweet domestic industry. Those stories and market analysis with Brian Roach next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, April 21 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The premature end of winter allowed construction crews a jump start on the season in February, but slowed in the last few weeks. The home building market overall is still strong in 2017. However, housing starts in March fell 6.8%, even as job security has improved with low unemployment. Existing homes remain hot commodities as the sales rate last month hit the fastest mark in 10 years. Purchases climbed 4.4% on tight supply and plenty of would-be buyers. Oil has hit a slump as OPEC mulls future production cuts, while domestic pumping hits a 1.5-year high. The Rural Main Street Index again is below growth neutral, mostly on weak farm commodity prices. The Creighton University snapshot reveals a 20th consecutive reading below 50 with a mark of 44.6. Donald Trump traveled to the dairy state this week as relations soured between many upper Midwest farmers and our neighbors to the north. The president renewed a call to buy American, even as the global economy is trending up. Peter Tubbs has the details.
The outlook for global economic growth has improved in recent months, but local trade skirmishes threaten to put a drag on trade growth in North America. The International Monetary Fund released its growth projections for 2017 this week, projecting global GDP growth of 3.5%, an improvement over 2016.
Acceleration will be broad-based across advanced, emerging, and low-income economies, building on gains we have seen in both manufacturing and trade.
The IMF credits stabilization in commodity prices and increases in trade and technology with the optimistic forecast, as the global economy continues to accelerate away from the global recession earlier in the decade.
Whether the current momentum will be sustained remains a question mark. There are clearly upside possibilities. Consumer and business confidence in advanced economies could rise further, though confidence indicators are already at elevated levels, relatively speaking.
Yet the economic rewards of the current expansion have been uneven. Flat personal incomes, despite GDP expansion, are causing individual nations to turn inward politically, which could result in protectionist trade policies and a reduction in global trade. One example of this struggle is the dispute between Canada and the United States over ultra-filtered milk. The protein liquid used in the production of cheese had been on a competitive price level with Canadian ultra-filtered milk, but changes in how Canada prices the dairy product puts Canadian dairy producers at a competitive advantage versus dairies south of their border. The pricing changes has forced American exporters to stop shipments to Canada, causing 70 dairies in Minnesota, Wisconsin, and New York, and hundreds of farmers to lose a valuable sales channel. In Wisconsin this week, Donald Trump renewed his campaign promise to put America first and pledged to confront the Canadians over the pricing changes.
And I've been reading about it, and I've been talking about it for a long time, and that demands really immediately fair trade with all of our trading partners, and that includes Canada.
Late this week, the Canadian Prime Minister said he was looking forward to having a fact-based discussion on the dispute. For Market to Market, I'm Peter Tubbs.
The world's largest coffee chain, known for whipping up sugary drinks, did it again this week. The Unicorn Frappuccino by Starbucks packs 50 grams of sugar into one 16-ounce drink. That's twice the recommended daily intake. Americans told Reuters in 2016 they were trying to reduce their sugar consumption. But domestic sugar producers say their product is safer and healthier than sweeteners made from other sources like corn. They seek trade protection in a volatile world market, as Josh Bittner explains in our cover story.
Good morning, and thank you all for being here today. The day we hoped would never come, but it's here. There's a modest sense of defeat here today as we're faced with the reality that we were not able to stave off the economic and external forces that have been conspiring against us for so long.
Last year ended on a sour note for a sweet domestic industry as Hawaiian Commercial and Sugar Company uprooted its long-standing Maui sugarcane plantation, the last of its kind in the Aloha State. Though Hawaii's sugarcane tradition stretches back nearly 200 years, industry officials believe limited federal protection and rising land values combined with pressure from environmental groups over cane burning and irrigation contributed to the crop's decline on the islands. So even though 165,000 tons of raw sugar worth $83 million was produced in Maui in 2015, the company lost roughly $30 million, prompting 2016's final harvest. As HC&S's parent company, Alexander & Baldwin, works to diversify 36,000 acres into a patchwork of orchards, row crops, and pasture land, remaining sugarcane producing states Texas, Louisiana, and Florida want to keep Hawaii's fate from reaching the mainland.
It's very sad because they achieve the highest yields per acre in the world. There's really no better place in the world to grow sugarcane than Hawaii.
Jack Roney is an economist with the American Sugar Alliance, a national coalition that lobbies Beltway lawmakers to ensure the survival of domestic sugar production amidst heavily subsidized foreign competition.
We're very proud of the fact that we are some of the lowest cost producers in the world while we are adhering to some of the world's highest standards for worker and food safety. We've really found a way to be both competitive and sustainable. And people wonder, well, if you're so efficient, why do you need a sugar policy at all? And the answer is in the distortions in the world sugar market.
The $20 billion U.S. sugar industry churns out about 9 million tons of sugarcane and sugar beets annually. But that pales in comparison to the over 1.5 billion ton worldwide yield. Roney says every sugar-producing nation subsidizes themselves, and surpluses drive down global prices, creating dependence on aid to offset the cost of production. Brazil leads the pack at 750 million tons of sugarcane, which USDA projects for the current harvest. The U.S. is the world's 5th largest producer, but also a net importer of sugar, where it's added to a wide variety of consumer staples. The industry claims U.S. sugar policy has cost taxpayers nothing for 14 of the past 15 years. However, a loophole in the North American Free Trade Agreement, or NAFTA, allowed Mexico duty-free access to dump tons of the sweetener on the U.S. market in 2013, pushing domestic prices to a 30-year low. So USDA ended up paying producers $259 million to keep the U.S. sugar industry from collapsing. Roney believes Mexico's move was a big reason Hawaii was forced out of business.
So the U.S. government responded and judged that Mexico had injured our industry and calculated subsidy and dumping margins of over 80%. It wasn't even close. And rather than put those duties in place, the U.S. and Mexican governments tried to work out an accommodation, but those so-called suspension agreements were not successful.
Our prices have remained stable. The world market pretty much dictates our domestic market.
John Hundley's family has farmed in the Everglades agriculture region of Florida for over 80 years and grown sugarcane there since 1960. Favorable weather the last few years has delivered a bumper crop on Hundley's 5,800 acres. about 300,000 tons by last count. In contrast with other states, Florida has its own set of challenges, from huge population influxes stressing the local ecosystem to the surprising cost of compliance.
We have a what they call an Everglades agricultural privilege tax that we actually pay on a per acre basis every year, and has been like that for well over a decade, maybe even close to 2 decades. And there's no other area in the U.S. that gets taxed to farm.
Hundley champions the Sunshine State's no-waste production model, where mills employ every part of the plant in processing, foregoing the need for fossil fuels. And despite implementing best management practices decades ago for his thirsty crop, Hundley says politically driven environmentalism has led to roughly 140,000 local acres being bought up and taken out of production over pollution fears. So pushing back against public misconceptions has become essential.
You know, we're farmers, and we can put up a fight all we want. A lot of times we lose. We got to win this one. We're able to farm this land pretty much year-round, and that's just that much less food that this area can provide for the consumers here in the U.S.
According to the United Nations, over 100 countries grow the bulk of the world's sugar supply, and Obama-era U.S. trade representative data indicates America buys the tropical sweetener from about 40 nations.
Unfortunately, it's getting worse. We seem to be moving further from free trade in sugar than closer to it.
As preliminary discussion over the 2018 Farm Bill ramps up, sugar advocates are seeking better prescriptions to handle offshore disruptions. Some like Roney find favor with President Trump's call for a closer look at U.S. trade agreements and are open to re-examining subsidies if other sugar-producing nations follow suit.
Ironically, there are some dogmatic free traders who think that it's somehow evil and protectionist to respond to foreign subsidizing and dumping. But that's really foolish. You're essentially just saying, we're not going to subsidize and we're going to give up our jobs to those countries who still do. That's unilateral disarmament. It's the antithesis of free trade. So we are encouraged that the administration is supportive of our pursuing our rights under U.S. trade remedy laws.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
The weakness of wheat held back the grain trade this week as favorable weather lowered prices. For the week, May wheat plummeted 6% to finish a quarter lower, and the nearby corn contract fell 14 cents. Any demand from exports was offset by an advantageous May forecast as the May soybean contract shed a nickel. May meal declined $7.90 per ton. In the softs, May cotton rose again, this time $3.37 per hundredweight. Over in the dairy parlor, May Class 3 milk futures increased 45 cents. The livestock sector was mixed. The June cattle contract improved $2 and May feeders rose 85 cents. However, the June lean hog contract dropped 6% or $4.17. In the currency markets, the U.S. dollar index lost 58 basis points. Crude oil tumbled $3.98 per barrel. COMEX gold gained $3.20 per ounce, and the Goldman Sachs Commodity Index plunged more than 18 basis points to finish the week at $383.15. Here now to lend us his insight on these and other trends is one of our regular market analysts, Brian Roach. Brian, welcome back.
Thanks, Mike.
Before we get started, you can listen to our market discussion anytime by downloading our market analysis and our Market Plus podcasts on our website, iptv.org/MTOM. Brian, we've got to talk about the wheat market. Holy cow. Where did we finish from a technical perspective in the nearby? Are we bouncing off those lows set fourth quarter 2016?
You know, if you look at the Kansas City wheat or Chicago wheat, I mean, they're both putting in contract lows here on the nearby. And it really tells you, you know, we came into this year with pretty good supplies worldwide and in the U.S., record wheat yields last year, and demand really hasn't been enough to strip those away. It tells you, you know, where prices were, and what we saw this week was favorable weather. We're shoring up the drought concern in the Southern Plains and out there in Oklahoma and Kansas City where it had been dry. And you're seeing that the specs are taking that as a selling opportunity. It looks like to me we're going to trade down to these record short net positions that we've seen before. Not quite there at a record, but we're close to that. We're tamping around that. And so I think wheat prices will have to look for a catalyst. And I don't know if wheat on its own generates a catalyst, maybe the European weather. But for the near term, I think we're going to have to wait for a catalyst. It may come in the corn market to get the specs to come in and cover some of these shorts and give us something worth talking about in terms of selling inventory.
Now, given the fact that we have such a massive short position being taken by these large-scale speculators, is this a time to step in and re-own with a call option some wheat that's already been sold?
It's a good practice if you're accustomed to it. You know, it's not for everybody, but it might be a way to get some paper ownership back on for bushels that you might have sold on some. We had a pretty good two rallies earlier this year that were worth selling, and so if you've been patient enough to get back on paper, now would be certainly a good time to do it. You know, the indicators that we use are telling us it's time to do that. We're down into the maximum net short area territory on almost all but the spring wheat and meal.
Okay.
And so you might look at that. The other thing to notice is that the volatilities on all the options is very low, actually very low. I mean, I just haven't seen them quite this low in a while. And so that tells you that those options are cheaper, all things being equal.
Well, now, while we're talking about the options, I want us to talk about the corn market. Old crop corn, is the trade still considering a massive crop coming out of Brazil? Is that still what's really overhanging the market?
Yeah, you know, corn and soybeans both. We're putting in what I call the Southern Hemisphere low, the harvest lows, just like we're used to in September, October, November in the U.S. The crops outperformed, and so now the market's fearing that they own the export markets for a little bit. And so, you know, back on the corn, I mean, nearby corn is trading in this 30-cent range, and we're down to the low side of it. These corn's trading to the low side of a 20-cent range. And so I think, you know, for the minute, we're going to probably trade down here and give your processors and your livestock guys a chance to get some feed needs bought.
Get some ownership on the table. Now, we've got a question here from one of our Twitter followers. We encourage all of you to submit your questions via Facebook and Twitter. This one is from Paul in Iowa. He's on Twitter at Northeast Iowa Farmer. He's saying, and I know he's not the only one in this boat, need to move some corn for cash flow needs and want to buy it back on the board in July. Do you prefer calls? And if so, at what strike price? Or are you outright buying futures at this point?
It's a good question. Is now the time to do it? I'd say before the crop is planted, perhaps, although the trade pattern that we're seeing, I call it a pre-planting low. And the specs are running this thing down cheap. If planting progress goes well, so let's say in a month, third week of May, we look at planting progress and the market's not too concerned about it, that'll be a better place to buy that call.
Okay.
Okay, so you have to look at it as though today looks like a good spot. If it becomes too expensive for some reason, although I think corn prices have little downside from here,
okay,
given the acreage perspective and the big demand, I think now's a good spot to do it. You may leave a little dry powder to buy some more in May.
Just in case?
Just in case. But the call option versus futures really, the narrow trading range doesn't offer the option trader as much upside.
Okay.
So a lot of guys are going to the future side because you're penny for penny, but you got to be able to handle the risk.
Right, penny for penny, both directions.
That's right.
Yes, indeed.
That's right.
Well, now let's talk about the soybean market. We've seen beans, finally it looks like maybe start to establish a bottom. Is that what you're seeing when you look at this market, the way it's been bouncing around both sides of that 950 mark on the nearby? Yeah,
you know, the Brazilian farmer has not been an aggressive seller. And if you look at the charts you're talking about, we're bouncing along, and we're actually bumping up against a short-term 20-day moving average. And if we get through that, we may see, you know, a small uptrend in prices, and that might give us a chance to sell something. But I like the trade action in beans. I am fearful, though, when you look at the acreage, a decent yield in the U.S. and maybe China thinking about planting more production of their own. I mean, growers need to be on the defense, willing to sell the next couple rallies here as we get into the growing season.
And that's the question. We're looking at big acres. We're looking at, you know, even a trendline crop is still a big carryout this year. For producers who are looking at this 960 on the Novi contract, that's pushing close to some guys' cost of production. How aggressive do you want to be managing that risk in here? Are we going to have a better opportunity?
We typically do.
Okay.
So if you look at the last 4 years, we've seen $1.80 to $3 moves in beans from the low, so whatever the low is. And so even if we just got a piece of that, if you think about it that way, that'd be $1 higher from the level we're at today. And maybe we go down a little lower, but I think to think in terms of just $1, that'd be the small side of what we've seen in the last few years. And so keep in mind that the U.S. still grows 33 to 34% of the world's bean supply. We have to grow a crop, and so it's still early too. I mean, we're just still here in the third week of April, not planting any beans. Never lost a bean crop in April, and so I think it's time to just be patient.
Okay, all right, just sit and watch.
Yeah.
One of the markets that is not very good at encouraging patience over this past week, Brian, is the cotton market. We're up almost a little over $5 in 2 weeks. Is this just export driven? Because we're not trying to buy acres anymore, are we?
I don't think so. I mean, I think what you're seeing is it's a tighter ending stocks situation than what we planned, what we saw 6 months ago. And yesterday's big move in the cotton market on big exports, and maybe you're seeing a little bit of weather premium creep into this. So you have big acres, but you know the weather is worrisome here for the cotton market. And so I think you're seeing a combination of both. I think we trade $80, just over $80 on the nearby. We took $1 off that today. New crop is made it through the 20-day moving average, and I don't know if we get $80 at a new crop. The weather will dictate that, but it looks like a selling opportunity coming really for both.
Okay.
Okay. Right here, right now on the nearby, and certainly the new crop looks like it could be a $77, $78 market. If things were to follow through next week.
All right. Well, now let's jump into the livestock market. The live cattle has been on a freight train, just screaming higher. When is that going to come to an end, Brian?
Well, when the market catches up, and right now the market's very current. Lower placements last fall, accelerated marketings here this first quarter 17. At the same time, you've got the carcass weights are falling. They fell $10 here in the last week, $26 lower than last year. And so you're seeing the nearby, offers stay relatively strong. Today's cattle on feed report, though, probably will play okay neutral on the nearby and into June. Okay. It looks to me like it'd probably be fairly negative on the August at 111%.
111% placements. Yeah. We saw 100% cattle on feed.
Just over.
And what was marketings? 104, 105?
104.5.
104.5. Okay. So all in all, fairly what the trade was anticipating in the nearby. Yeah. But that 111%, that's a lot of cattle going on feed.
Yeah. So, guys have been selling this all the way up. It's continued to go higher than most cattlemen and analysts probably thought. And so there's some stuff that's been sold on the way up here. And I think the question is, should I sell some more here front part of next week? And the answer is probably yes. Okay. If you go back a couple months ago, we're looking at a way different situation. Yeah. So I think a guy, cattle operations willing to take some profit, bake in the input costs through harvest right now. Same with all the livestock is strike out these prices on the feed side right now and look for opportunities to sell. But when you can sell with the kind of profits that we're looking at today, it's probably wise to go ahead and play something here at these levels.
Okay. Now, as we take a look at the feeder cattle market, that of course is also screamed higher right along with fats. But I've noticed here this week in particular, we started to see the feeder fat cattle spread begin to widen. Is that something we encounter seasonally in here?
It is. Grilling season, spikes the live side a little more, but I think the feeder situation is much like that. It's looking for direction. If you looked at the futures, it kind of went sideways here on into this report. So we're really looking for direction. But I think both beef markets remain pretty strong here, at least on into the next month.
Now, the 111% placements, is that bullish for feeder cattle? Looking forward, are we pulling calves forward? Can you read it that way?
Yeah, I think if you look at the weights, if you think about the weight scenario, it tells you the market's very current. We're stripping the feeder market out. So if you're a feeder guy, I think the upside remains pretty strong. If I talked to a cattleman yesterday who 2 months ago, feeder guy, and you know, he was wanting to hedge 120, and here we are, you know, $20 later, talking about should we do something here? And I think with the input costs driving profits, it's time to do something. It's time to take a sizable increment off the table.
Okay. Now let's talk about lean hogs. A mirror image of the live cattle market. We just keep getting beaten down week after week now, and the lean hog's down $4 this week. What's the story?
Well, it's about supplies. The Hogs and Pigs report was it gave the USDA a chance to kind of square up the numbers, but the, you know, at the end of that report, if you look at their growth projections at 1.5%, the numbers are still going to be there, and you know, carcass weights are continuing to come up. It's really, the onus is on demand in the hog market for now. And if you look at the USDA's number, upwards over 8% expected in exports, that really has to be a part of it. But you know, I look at the carcass weight, or the dollars, the cutout values, have leveled off, and that tells me that demand is pretty good. And typically, when you look at the cattle market, we have a seasonal rise here of anywhere. We typically capture $12, $15, $17 on into summer. So I think if the hog producers got the input side covered at low prices, you wait for that. I mean, that's not a guarantee, but if you look for that $10, $15 move in futures, that's a good selling opportunity to bake in some profits.
All right. Well, Brian Roach, thank you so much for taking the time to join us.
Thanks, Mike.
That wraps up the broadcast portion of Market to Market, but Brian and I will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and in video form on our website. While you're there, check out the link to our Flipboard magazine, Market to Market reading material. Each day, our producers update the collection of news they are reading and put that in one convenient location. And join us again next week when we explore how industries in Louisiana are helping shore up the Gulf Coast. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.